Hello and welcome to More Than Commas. I'm Paul Adams, and today we'll be discussing a how-to on setting up and funding your backdoor Roth IRA. A backdoor Roth IRA is for those of you who make more income than is allowable to contribute directly to a Roth IRA. Now, you've probably heard that you make too much money to contribute to a Roth. But today we're going to teach you a strategy often used by high-income earners with the right advisors to fund a more tax-efficient future. Let's start by laying down a foundation. A traditional IRA allows you to contribute $7,000 annually in 2024 or $8,000 if you're over the age of 50. The beauty of a traditional IRA is it offers tax deductions for contributions provided you meet specific criteria, such as not having access to a 401k through your employer. This means the money you contribute reduces your taxable income for the year, which is why many people use this vehicle to save for retirement. However, when you eventually withdraw the funds in retirement, these withdrawals are taxed as ordinary income. Now, many people aim to retire at a lower tax rate, assuming that their income in retirement will be lower than during their working years. But as we've talked about before on this podcast, there is no guarantee of that. With the uncertainty of future tax rates, coupled with the possibility of having multiple income streams in retirement from Social Security, pensions, investment income, or even part-time work, it's entirely possible you might not be in a lower tax bracket. That's where the Roth IRA comes in. With a Roth, you contribute after-tax dollars, and all qualified withdrawals in retirement are tax-free. This makes it an extremely powerful tool for diversification in your retirement planning. However, high-income earners face a significant challenge with the Roth IRA. In 2024, the Roth IRA income phase-out for married couples filing jointly starts at $218,000 of income and ends at $228,000 of income. For individual single filers, the phase-out starts at $138,000 and ends at $153,000. What this means is, if your income exceeds these limits, you can't contribute directly to a Roth IRA. And for those of you married and earn over $228,000 or single and earning over $153,000, this option is entirely off the table. So what do? This is where the backdoor Roth IRA comes in. A strategy that's going to allow high-income earners to bypass these income limits while still taking advantage of the tax-free benefits of Roth IRA. We're about to break this down and how this process works.
This episode is brought to you by Sound Financial Group. At Sound Financial, we specialize in helping clients build strong, long-term financial strategies for their retirement. If you're looking for personalized advice to help manage your wealth, visit us at sfgway.com to learn more about how we can help you achieve your goals.
Now let's dive into how the backdoor Roth IRA works. Essentially, this is a two-step process. The first step is contributing to a traditional IRA, even if it's a non-deductible contribution because your income exceeds the limits for a deduction. The second step is converting that traditional IRA to a Roth IRA. The good news here is that there are no income limits on conversions from IRA to Roth IRA, which means this is available to virtually anyone regardless of income. So let's walk through an example. You make a non-deductible contribution to your traditional IRA, say $7,000, then you immediately convert that traditional IRA to a Roth IRA. The only tax you'll owe is on any growth or earnings that occurred between the contribution and the conversion, which if done immediately will likely be minimal. Once converted, that money grows tax-free, and when you withdraw it in retirement, it's tax-free as well. However, this is where things get a bit more complex. The pro rata rule. This rule comes into play if you already have other pre-tax IRA assets. For example, let's say you've got an existing IRA with $54,000 of pre-tax money. When you try to convert the $6,500 in your new contribution to a Roth, the IRS looks at all your IRAs combined as one account. That means you have to pay taxes on a percentage of the conversion based on the proportion of pre-tax to post-tax money in all your IRAs. In this scenario, if 90% of your total IRA balance is pre-tax, you have to pay taxes on 90% of the conversion. So instead of converting only the non-deductible contribution tax-free, you end up with a tax bill for a portion of the pre-tax money that gets converted as well. This is where many people get tripped up or avoid doing the backdoor Roth altogether. There are solutions to this, however. One strategy is to roll your existing pre-tax IRA into a 401k. If your employer plan allows it, that is. By doing this, you move the pre-tax dollars into 401k, which removes them from the pro rata equation, leaving only your new non-deductible contribution to that IRA. Then you can convert that contribution to a Roth IRA without triggering the pro rata rule. Another reason many people don't hear about this strategy is simply because the financial institutions don't actively promote it. Why? Because it doesn't benefit them as much as other strategies might. They're not incentivized to explain the nuance of the backdoor Roth IRA and the pro rata rule because it requires careful planning and might result in fewer traditional IRA assets that they're going to have under management. It's also underutilized because of the complexity involved, but with the right guidance, this can be a valuable tool for high income earners. If you want to learn more about the backdoor Roth and how you can use it, go to www.sfgway.com and download our Roth IRA cheat sheet. Thanks for tuning in to More Than Commas. Next week, we'll be diving into the differences between traditional 401k and Roth 401k. So make sure to join us, and as always, visit www.sfgway.com for more resources. That's it for this episode. Now go back to building a great life.